Welcome all to the Analyzing Financial Statements video of the RMA Lending Challenge series. Hopefully you've seen a handful of other videos before this, and obviously if you've been viewing these videos, you will know that being part of the RMA Lending Challenge, you're going to be challenged quite a bit just professionally in this case. A lot of work has gone into these cases that go before you guys. You may or may not have already received your case, but just know the RMA board works heavily to get those going. And you guys will obviously be doing a lot of work between now and the actual challenge itself, which hopefully both of us will actually be at. So good luck to all of you. With that said, I'm going to introduce myself and then I'll let our guest introduce himself. My name is Ryan Henderson. I'm one of the commercial credit managers at Mercantile Bank. Been here for about 5 years, but I've been in banking for upwards of nearly 20 years. So I am a self-professed numbers geek. So some of you may find that refreshing. Others of you may just roll your eyes at that. That said, pass it over to my guest.
Thank you very much, Ryan, and to all of the people watching this video. My name is Chris Putman. I'm the corporate credit manager here at Mercantile. I've been in banking in the credit role for the last 30 years, and I'm happy to talk to you, Ryan, and to all of our listeners about financial analysis and what goes into all of that.
Really dry topic, I know, but we are going to try and make this as exciting as possible. So let's get started. So Chris, what are we trying to answer with financial analysis?
Yeah, there's really a couple of things that we focus in on with regards to financial analysis. The first one is what impacts will various trends, those sorts of things, or unusual items, what impact will that have on the company's ability to generate cash flow in the future. For the vast majority of our underwriting and analysis, it's focused more from a borrowing perspective. So what are those things that we identify with the financial statements, and what is that impact going to be as it relates to the ability to repay debt in the future? And then the second thing is really looking for characteristics within those financial statements as to this company's ability to weather a downturn or maybe an issue from a performance standpoint in the future.
Sure. So you just mentioned a whole lot of stuff, and I'm sure a lot of you guys watching are going, oh man, where do we begin?
Sure. Ryan, usually there's three areas that I focus in on. The first is the key financial ratios. Secondly is the income statement. The income statement is pretty important to me because that's really the starting point for looking at cash flow.
Sure.
And then lastly is the balance sheet that I will focus in on. And really at the end of the day, analyzing is part of it, but being able to ask questions and investigate and research is really the important component to the financial analysis job.
Sure. So as I'm sure a lot of the students have learned throughout their time so far in school and working with their professors, that analysis, again, numbers geek, involves a lot of calculations and ratios and so forth. So with that said, what sort of ratios are you typically looking at or using when you analyze financials?
Ryan, really there's three areas that I look at. That would be liquidity, leverage, and then one that's near and dear to me, which is fixed asset utilization.
Good. Looking forward to hearing a little bit more about those. In fact, which liquidity ratios do you use, and what do they communicate to the analysts as they're calculating those?
Sure. Ryan, I start out with what I think many people are very familiar with, which is working capital. Mm-hmm. From there, I then transition into the current ratio. I mean, both of those are really an indication of the company's ability to support current liabilities with current assets. So you'd expect your working capital ratio to be positive and your current ratio to be better than 1-to-1.
Sure.
And then really what I would say, once I've looked at that liquidity, I start to transition a little bit to some of those components of working capital. So I'll start with accounts receivable days on hand. Really what I'm looking for there is how quickly can a company convert their accounts receivable into cash. I will also take a look at accounts payable days on hand. Accounts payable days on hand, just very similar to accounts receivable, but on the other side, as opposed to looking for how quickly they receive cash from their customers, it's how quickly they pay their vendors. Both of those ratios we like to see in that 90-day category. Anything beyond that, it starts to be a potential red flag that we would have to look a little bit more closely into from that standpoint. And then following up with that is the inventory days on hand. This one's a little bit unique, whereas the other two were very much focused on receipts of cash coming in or cash going out. Inventory is important for us to see, are they holding on to inventory too long? So is there a particular item that's in their stock room or warehouse that isn't selling and maybe stays on the books for a really long time, which may be an indication that maybe they are not turning that over quickly enough.
Sure, sure. So the receipt of cash, the payment of cash, and then inventory, how long are they keeping it? And you said AR, 90 days is really what you're looking for. AP also 90 days. What about your inventory days? Also 90 days?
Well, inventory, it really depends on the particular type of inventory that you're dealing with. If you're talking about something that lasts a really long time, it might be okay that it's sitting on inventory for 30 or 60 days. But then again, if it's a perishable item, it might be pretty moldy at that point in time. So really when it comes to inventory days on hand, I would really recommend that people are looking at what is the industry and really stepping back what makes the most sense for that inventory type.
Good. So not necessarily 90 days, but it really kind of depends on the industry in which they look at. So that's good. Moving on a little bit here, what about leverage?
Sure. There's a couple of different leverage ratios that I focus in on. First one would be debt to net worth. Really that particular ratio gives us a sense of that company's ability to weather a downturn. The more equity they have in their assets, the more flexibility they have to potentially liquidate some of those assets to come up with some quick cash, or potentially leverage up on those assets, or it could be an indication that they have less debt and therefore lower burden on their cash flow. Usually for a debt to net worth, anything 3, maybe 3.5 to 1 is kind of on the high side. Anything less than that is something a little bit more reasonable. What we would consider a really strong borrower would be someone in that 1-to-1 or less than 1-to-1 ratio from there. Secondly, I oftentimes look at an operating cash flow leverage, which is a funded debt to EBITDA. Funded debt, there's a million different definitions out there. This one that I've typically used is any interest-bearing third-party financing that the company has. So that funded debt divided by EBITDA. Really what that's telling me is how quickly the company could pay off their debt. If that was truly their focus, is to get out of debt as quickly as possible. And usually 3-to-1 is kind of the target there. That anything higher than that would be pretty leveraged for your typical business, and something that would potentially be a red flag that we would have to look at a little bit more closely.
Sure, sure. All good information. You had briefly mentioned equipment utilization ratio. What were you referring to in that situation?
Sure. Yeah, there's one ratio that I tend to use quite a bit, and it's the sales to net fixed asset ratio.
Okay.
And really what that demonstrates to the analyst is how much sales dollars do they generate for every $1 invested in fixed assets. So you can really get a sense of whether or not a company is utilizing their equipment and their fixed assets to the best of their ability. So if you really have a business that has a sales to net fixed asset ratio that's much weaker than the industry. So maybe the industry would be generating a 20-to-1 ratio, and your particular company that you're analyzing has a ratio of 5-to-1, and they're asking for more equipment, then it's an opportunity to investigate why do they need more equipment when today they're less efficient or not utilizing their equipment as well as other companies in the same industry.
Interesting stuff. Equipment utilization. All right. So we talked a lot about the numbers, and again, that's near and dear to my heart, and calculating a lot of ratios and what they mean when looking at them. But besides the ratios, what else are you looking for when analyzing a borrower or even a prospect?
Sure. Really, when it comes down to completing your analysis, you start out with the ratios, you cover those, and then I really start digging into the income statement, the balance sheet, and the other portions of the financial statement. Really, what I'm looking for there are two items. One is trends, things going up, things going down, and then in addition to that, what unusual items or unique accounts or very large accounts that kind of stand out, what are those things on the financial statement? Because ultimately we're trying to see what that would do to the company's performance down the road and their ability to support debt.
Sure. So as you're doing that and you're going through the process, is it good enough to merely identify the key risks?
Really, we have to go a couple of steps beyond that. When you identify these particular items, the trends, the unusual items, that's really just the starting point. And if you think of what we're here to do, we're to provide that analysis, but that's not just reporting, that's digging into it and determining what that information is telling us. So that means you're investigating through research, and you're talking with customers and finding out from them what are they seeing with regards to those trends. Are those trends or unusual items going to continue? And if so, what is that going to do about the ability of that borrower to support financing in the future?
Sure. So a lot of calculation of numbers, a lot of research, independent research. Obviously in real life situations, you're going to have access to customers and so forth. But as it relates to the RMA lending challenge, is it possible for teams to talk with representatives of the case study company?
Unfortunately, in this type of scenario where we are going through the process of the underwriting, there's not actually a company that we are looking into and investigating and researching. So it's not possible to have that interaction with a customer. But I really feel it's important to bring that up
Sure.
for all of the students that might be considering a future in banking, that it's not just crunching the numbers, looking at the analysis, it's doing that research, it's talking to people, finding out what they know, and assessing what those risks are based on that research that you do through those conversations.
Sure. A lot of good information spilled out for everybody here in a short video. The process that Chris just explained is a very lengthy one. It's a lot longer than than we had time here today. But with that being said, just like to thank Chris for your time stopping by, explaining the process. I'm sure there's going to be more questions that come out of this, but again, thank you for your time.
No, thank you very much, Ryan. Greatly appreciate the opportunity to talk to you about financial analysis. So very much appreciate that, and good luck to all of the students and the RMA Lending Challenge. Best of luck through this year's competition.
Thanks all.